Good morning, this is Business Live with me, Ian King. Now, a report out this morning estimates that there's a 90% chance that public borrowing in the UK will be £40 billion higher in 4 years' time than forecast by the Office for Budget Responsibility. The Institute for Fiscal Studies estimates will come as a blow to the Chancellor, Jeremy Hunt, who's facing pressure on all fronts, including from his own backbenchers who want tax cuts before the general election. Well, joining me now is one of the report's authors, Dr. Isabel Stockton, the IFS Senior Research Economist. Isabel, welcome to you. Why do you expect borrowing to exceed the OBR forecast?
Good morning, Ian. So what we've shown in our work is that past chancellors have shown a pattern of behaviour in that they've responded in an asymmetric way to news that come along over the forecast period. So when things have improved, they've tended to spend that windfall. But when things have deteriorated, the economy has performed less strongly than expected, then they haven't offset that change in quite the same way. Instead, they've allowed borrowing to rise. And over time, that leads to a ratchet effect, which means that the initial forecast, which is meant to be central, really isn't so central. And instead, there's a high chance that borrowing will turn out higher.
So why do chancellors behave differently to good and bad news?
Well, we can imagine that it is just more difficult for chancellors to sort of face the fact when there is a piece of bad news that comes along, and perhaps they just sort of hope it goes away or face political pressure to not increase taxes or cut spending. Whereas if there's a windfall, then there's going to be lots of clamour, lots of demands on that windfall. And it's not so easy to say, actually, I'm going to use this windfall to reduce borrowing.
Do you think that is because of the climate we've been living in? I mean, I think I'm right in saying your research goes back to 2010. I mean, it's the post-austerity period. You can't blame chancellors for wanting to raise public spending when they've been cutting spending to the extent that they have been.
Of course, and we're not actually saying that borrowing or debt have been too high. It may well be that it was appropriate or even optimal to have the path of borrowing that we've seen. And what we're highlighting is really an issue with transparency, in that the forecast as it is set out initially is not realistic when we don't account for this asymmetric behavior. So it would be a different story if chancellors at the very beginning had stood up and had said, this is the amount I want to spend on any kind of political priority. We're not making a judgment on that.
It's quite interesting. If you look at the current position on government borrowing has come in slightly south of where the OBR thought it would be so far this financial year. Is that just because of inflation flattering income tax returns?
That is a really important point. So it's hard to be sure exactly, but at least the numbers as they've come in so far have been consistent with this story, that really what we're seeing is nominal GDP and underlying that inflation have outperformed the forecast, and then you get a sort of mechanical effect in that you also get more tax revenues in cash terms because the economy is just bigger. But that doesn't necessarily mean that there's good news about either growth or about the tax richness of that economic growth that would really warrant a change in the Chancellor's strategy.
How difficult was it in this research to divorce the personalities of individual chancellors? I mean, because from what you're saying, the fact that borrowing is coming in below the OBR's forecasts, one would expect Jeremy Hunt to sort of spend that money rather than, for example, put it towards tax cuts.
Well, of course, we can't be sure that future chancellors, or indeed the current chancellor, will behave exactly like their predecessors. So what we're highlighting in the report is really that this has been happening for ever since the creation of the OBR, that has allowed us to even do this decomposition, the availability of these forecasts. We can't be sure that this will keep happening, but I think viewers will agree that if something keeps happening for a decade, it's probably a good guess that it's not suddenly going to change. But you're right to say that it is up to chancellors to change this pattern. So a chancellor could use whatever political clout he or she has to resist demands for this asymmetric behaviour and set out a more realistic, more central plan.
Yes, it's a fair point you make. Of course, a lot can happen in 4 years. I mean, we might have a change of government. We'll also almost certainly have a different chancellor. I just think back to the late 1990s when Gordon Brown stuck to Ken Clarke's spending plans, and Ken Clarke himself subsequently went on to say, well, we wouldn't have done that.
Correct. And of course, we're not saying that chancellors should never respond to events or change their plans. Really, the issue is just that because of this asymmetry, there's a ratcheting effect that means that the central forecast as it is presented is really not so central, and that's a problem for transparency, and transparency in turn is important for appropriate scrutiny. So we might look at that central forecast and say, right, so debt is on course to be stable. For example, that was the case in the March forecast. If we take into account this tendency of chancellors to behave asymmetrically, that may no longer be true. And so it's really an issue about getting a clear-eyed and realistic picture of the state the public finances are in, rather than making a judgment call about what the appropriate policy response to any kind of change should be.
Well, it's a fascinating piece of research you've done, Isabel. Thanks very much indeed for coming on to talk about it. Appreciate it.
Thanks, Ian.
Now, Britain is at less risk of power cuts and blackouts this winter than it was last winter. That's according to reports published today. The National Grid Electricity System Operator, which balances demand and supply on the grid, says it expects to have 4.4 gigawatts of power in hand to meet its reliability standard. That represents 7.4% of capacity, up from 6.3% last winter. But it does not rule out having to pay households and businesses to reduce their consumption at key times. Well, joining me now is Jake Rigg, the Director of Corporate Affairs at National Grid ESO. Jake, morning to you. Is this because you expect demands to moderate or because supply has improved?
Good morning. Very much because supply has improved, and we have greatly increased confidence in a number of different factors that underlie that. So the way we go about analysing demand and supply for the coming winter, something that we do every year and have done for decades, is that we take over 50,000 scenarios. So we look at wind variability, temperature, all sorts of permutations of that, so that we can really understand renewables and variable renewables. We can also understand what is going on with outage patterns amongst the generating fleet, so gas, combined cycle gas plants, lots and lots of different types of generation. And then we will effectively derate that plant. So we will work out how available it could be under all those 50,000 scenarios. And what the analysis says, as you said, is that actually we've got plenty of supply to meet demand. There are still, though, a number of risks out there. So whilst those risks that were caused last year by Russia's illegal invasion of Ukraine and frankly, huge volatility on the international energy markets, what we're now seeing is that actually there's much greater confidence from our cousins at the gas system operator, who are saying that actually there will be plentiful supply of gas this winter, even in some pretty extreme scenarios. So that gives us a lot more confidence that there'll be enough gas generation in GB. Having said that, there are still risks out there. There is a war in sort of very, very close to home, unfortunately. And there's therefore still sort of slightly elevated prices on the wholesale international energy markets, which says that there is still some volatility out there. And as a result, what we're doing is that we're continuing our demand flexibility service that was really popular. 1.6 million households took part in it at some point or another last winter. I myself did that with my family, with my two young kids, and actually quite enjoyed it, to be honest. Got to spend some time with them rather than looking at a screen all the time. But we're doing that, to protect supply and make sure that there is plenty to go around, but also because actually we do acknowledge that domestic prices are still really high and business energy costs are still really high. And okay, it's not a huge amount of money that people will make from it, but actually every little does help. And it's quite nice to see energy organisations such as ourselves putting a little bit back in, really. So those are the two main drivers for the demand flexibility scheme.
Obviously, the extra capacity available this year at 7.4% is higher than it was last year at 6.3%. But how does it compare with the longer-term average?
Yes, so it's pretty much in line with what you might call a normal winter. About the average for the last 5 years prior to last winter. Slightly higher than some years, slightly less than some years. But it really does sort of signal a returning a bit more to normal than what we've seen in certainly last winter.
OK, Jake, got to leave it there. Thanks for joining me today.
Thanks.
Some other business news stories for you now. And the Bank of England this morning set out how it will reform the rules governing how much capital insurers must keep on their balance sheet. Changing the so-called Solvency II rules, which has been made possible by the UK's departure from the EU, is expected to free up tens of billions of pounds, which can instead be invested in the economy. The bank said today that final policy and rules would be set out by June next year. As part of the reforms, the bank will begin publishing stress test results for individual life insurance companies from 2025, instead of simply disclosing aggregate results for the sector as at the present. The Competition and Markets Authority is to launch an in-depth investigation into the takeover of Whirlpool's European appliances business by the Turkish company Arçelik, the owner of the Beko brand. Well, the deal, announced in January this year, would create the biggest supplier of washing machines, tumble dryers, dishwashers and cooking appliances in the UK. The competition watchdog said it was concerned that the tie-up could reduce competition in the low to mid-price end of the domestic appliances market. The parent company of Poundland has issued a profits warning for the second time this month. Pepco, which is listed on the Warsaw stock market, said underlying earnings for the year were likely to come in at around €750 million, compared with €731 million last year. That would represent growth of less than 3% this year. Until the profits warning delivered earlier this month, it was predicting sales growth of around 15%. Well, Pepco also reported that a second senior executive was stepping down. Its managing director, Anand Patel, will leave with immediate effect. The company's chief executive, Trevor Masters, went earlier this month. And the Sony executive who oversees the PlayStation is to step down in March after 30 years at the company. Jim Ryan, who's British, will be replaced as chief executive on an interim basis by Sony's group president, Hiroki Totoki. Mr. Ryan has been at the helm of PlayStation since 2019, since when the PS5 has become the dominant player in home consoles. Sony expects to sell a record 25 million PS5s this year. Well, the oil price hit a fresh 10-month high this morning on continued concerns over supply tightness. At one point, Brent crude hit $97.69 a barrel. That's the highest since the 8th of November last year. A barrel of Brent crude currently changing hands at $95.93 a barrel. That's off a little over under two-thirds of 1%. On the equity markets, well, stocks in the Asia-Pacific region traded largely to the downside overnight. The Shanghai in Tokyo suffered its biggest one-day fall in a month. I think that Shanghai figure you can ignore. There's a public holiday in China today. In Europe, stocks are trading to the downside for a sixth consecutive session, by and large, although you can see some of the individual markets are higher there. The big talking point is that Germany is due to publish its inflation data in the next hour. A lot of interest in that. Among features, well, the French energy giant Total is 1.5% up. That takes it to an all-time high after it sold a stake in an Angolan oil field to the Malaysian energy giant Petronas. Well, here in London, the FTSE 100 is firmly in negative territory, off a fifth of 1%, a broad-based sell-off led by house builders and travel stocks. A number of stocks are automatically lower today because they've gone ex-dividend. In other words, they're trading for the first time without rights to the latest payout. They include M&G, Rightmove, Smurfit Kappa and British American Tobacco. All of those automatically adjusting lower because they've gone ex-div today. So don't panic too much if you own shares in those. Outside the FTSE, the investment firm Digital 9 Infrastructure has fallen by 28%. That's after it scrapped its quarterly dividend, while the gaming firm 888 Holdings, as you can see, is down more than 16% now. That's following a profits warning. On the foreign exchange markets, meanwhile, well, sterling's been drifting over recent days, but it's trading to the upside this morning, currently ahead by just under 0.5% against the US dollar, up a sixth of 1% against the euro. The single currency, meanwhile, up a third of 1% against the greenback. Well, joining me this morning is Patrick Farrell, the Chief Investment Officer at Stanley. Patrick, good to see you this morning. What a rotten month September has been in the US in particular. You know, the Nasdaq and the S&P have had their worst months of the year, and bonds have sold off too.
Yeah, it's been a bit of a struggle, absolutely, for September. I think the main sort of driver behind this is the fact that the US Federal Reserve has come out and they've said, look, you have to believe us, we're going to keep rates higher for longer. And as a result of that, the market is suddenly sort of getting to the realisation that, well, that means that it's going to put pressure and more headwinds ahead for markets and for the economy itself. And with the move in the oil price, as you mentioned, it's been one of the sort of key drivers that if I'm a central banker, I'm actually going to get a little bit worried about that. So, it's definitely going to cause some concerns and a lot more discussions at the central banks.
Patrick, what about US Treasuries in particular? I mean, the yield on 10-year Treasuries is back at 4.5%. First time it's been there since the financial crisis in 2007. Is that something people should worry about? Because I saw some research elsewhere today saying, well, that's basically where it's been for the last 200 years.
Yes. I mean, what viewers do need to realise is that the last 10 to 15 years has been an anomalous period. So, and now we're moving back to a more normal economic cycle. With the US Treasuries trading, the 10 years trading above 4.5% in yield, it is a high level, and it does represent the fact that inflation is likely to sort of stay higher for longer as well. And as a result of that, the fact that short-term rates are going to stay higher for longer. I think there will be an equilibrium period where US Treasuries, a 10-year in particular, could sort of move back to 3.5%. So as a long-term equilibrium level, that seems to be a little bit more realistic. But there are still inflation risks that are basically coming through, largely as a result of energy, but also when we look at some of the food prices and some of the grain prices and what's happening in agriculture, there are concerns still in terms of supply and demand.
Well, speaking of inflation, we get the German print this hour. What are you expecting to see there, and to what extent might it affect the ECB's thinking on where they go from here?
Well, some of the regional German numbers have already come out. They've come out pretty much in line with expectations. So from that perspective, I actually think the German number could come out pretty much in line. So as a result of that, the headline inflation will come down, the core inflation will come down. And so that will be a pleasing result. I think the markets are very scared about any potential upside. So as a result of that, I think there could be a bit of relief. There certainly will be relief from the ECB, and they will look at it. The credit numbers that came out in Europe just highlighted the fact that there is a lot of credit contraction coming through in Europe now. And as we know, a lot of corporate financing is done through the banks and loans. So that's a little bit of a worry. And I'm sure the ECB will be very much, on the side of looking at some of these credit expansion numbers or contraction numbers and starting to worry a little bit more.
Can one safely rule out further interest rate rises from the ECB, though, would you say?
I think the central banks in general, and including the ECB, will not be in a position where they will err on the side of caution in terms of the economy. So they will absolutely keep rates tight as inflation is still well above their target. So as a result of that, any pressure, particularly coming from oil prices or food prices, will continue to sort of see the potential for a tightening. We can't necessarily discount that. The markets next year, as we sort of move into the second half of 2024, do have expectations of rate cuts coming through. But in order to change the ECB's mind right here, right now, you're going to need to see some substantially weaker numbers coming out, particularly for some of the southern states in Europe, because we know that Germany is already weak. The manufacturing engine of Europe is basically stalling at the moment. But the tourism numbers coming through for the southern states is what's keeping Europe a little bit more afloat. Any danger to that, and then I think the ECB will be sort of thinking, no, we're done. That's it. We need to sort of wait and see how it all pans out.
OK, Patrick, got to leave it there. Good to see you as ever. See you in the fourth quarter. Thank you.
Thanks very much, Ian.
Still to come here on Business Live. The extraordinary story of the London-listed Burford Capital and a $16 billion lawsuit. Don't go away.
I'm Katie Spencer and I'm Sky News' arts and entertainment correspondent. When you think of Glastonbury, it's mud you want and music. They're going to cross to us live in a minute. Okay.
We always were capable of doing this.
Oh, they're wonderful children as an audience.
Who did that? Maverick here on the red carpet. I'm so excited. We take you to the heart of the stories that shape our world.
Nor have I ever struck any woman in my life.
There's this illusion of power.
Are you feeling well?
I remember covering the Oscars and that now infamous moment, the Will Smith slap. You can tell from these crowds just how excited people are for the return of Fly.
These actors playing the lead roles were born long after the Sex Pistols broke up.
As a team, we've interviewed some of the biggest stars in the world.
Okay, I'll talk to you.
Don't leave me.
Yeah, okay.
There's no easy goodies. There's no easy baddies.
Thank you.
Thank you.
Bye.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. The last decade has seen an upsurge in litigation funding as companies and individuals seek financial support to pursue legal claims. Well, the biggest player in the field is the London-listed Burford Capital, which has just received a ruling in its favour from a New York judge after its client sued Argentina over the country's illegal nationalisation of an oil company in 2012. Well, joining me now is Burford's founder and chief executive, Christopher Bogart. Good to see you this morning. Your clients have won the case. The challenge is going to be getting the money out of Argentina now.
Well, that's the next step in the process, but you're absolutely right. What Burford does here is represent creditors and other financial investors. So we're appointed by, in this case, the Spanish bankruptcy court to try to pursue some relief.
There's talk of seizing assets from Argentina. What sort of things might be taken?
I think the way that you deal with judgment enforcement, and we do this all over the world, it's a significant part of our business, is not to engage in that kind of strategy immediately. Instead, it's to figure out ways to have a constructive dialogue. It's to get the other party to the table and ultimately have them understand why it's in everybody's interest for a judgment like this to be paid.
There is a precedent, though. I mean, Elliott went after Argentina and seized a boat from its navy a few years ago.
They did, but that didn't get Elliott very far. And at the end of the day, what ultimately got Elliott a resolution in its matter, just as we would expect here, is a constructive engagement with the Argentine government.
How much has it cost to bring this case so far?
Well, we've got something on the order of $50 or so million invested in this matter already, and there are going to be further costs as the case goes down the road. So, and this is exactly why businesses like ours exist, because if you think about what happened here, shareholders, had promises that were made to them broken by Argentina. Argentina was obliged to tender for their shares if they retook control of YPF. They didn't do that. They broke that promise. And so the problem is that caused those shareholders to go into bankruptcy, and they don't have the capital or the expertise to be able to pursue these claims on behalf of what is now the creditors of the bankrupt estate. So that's where we come in.
This case concerns Argentina confiscating a business that was ultimately Spanish-owned. Why was the case heard in New York?
Because all of this began with Argentina listing YPF through an IPO on the New York Stock Exchange. And as part of that IPO, Argentina made a promise, which is that if it then retook control of YPF, it would tender for the shares, the public shares that it had sold on the New York Stock Exchange. And that's what gave the U.S. court jurisdiction.
Gotcha. What were the main obstacles in bringing the case thus far? $50 million is a lot of money.
Well, Argentina has a playbook, effectively, when it does these things. This is obviously, as we all know, far from the first time that this has happened in Argentina. And so what Argentina is doing as a strategy is saying, look, I'd like these assets. I know I'm supposed to pay for them, but I really don't want to right now. And so instead, they take the assets, they don't pay, and then they engage in a very long campaign of litigation. So we're now 11 years after the breach of that promise, and we're not done yet. And it's not a crazy strategy. Yes, Argentina is going to be ordered to pay what it should have paid originally, but the interest rate that the creditors will get is lower than Argentina's cost of debt.
Chris, got to leave it there, I'm afraid. Good to see you today. Thank you.
Thanks, Ian.
That's it from me. I'm back at 4:30 this afternoon. Hope very much to see you then. Stay tuned. Up next, it's Jane Secker. Sorry,